Last year in 2024, I made a video on how to invest for beginners and it generated more than 30,000 views. So this year will be a brand new update for year 2025 because I have grown a year wiser and see how it can add value to your life, especially for those beginners who want to start investing. And let's set the record straight because I already published a video where I detail out my 1 million Singapore dollars portfolio, which is majority in equity investments. So it's really a been there, done that thing, like to show you the path of how you can achieve your own level of your financial freedom. But to highlight again, 1 million SGD is not my goal because 1 million USD by 35 is then my goal. So I'm still working towards it and I'm in the same process as you. I am not a stock pick guru. I will not tell you what stocks could 10x or moonshot to your way to financial freedom because I'm not one of these guys. My investment strategy is very boring, very unsexy. Those things that you cannot howl in or show off to other people that I'm a master stock picker. No, I'm not. It is just a very passive, defensive investing strategy that may be boring to some of you. It's like the turtle, in the turtle and hare race. But I'll touch on more about this strategy later. So if you want some moonshot advice from me, sorry, I really don't have. And before you start investing, I always advocate that you clear your high interest debts first, those that are hovering more than 4% per annum, be it like your education loan or your renovation loan. Some of you take loan for wedding even. Oh my god. So clear all these high interest loans first and have sufficient insurance that can cover you in the event that you are not able to work. Because all these defensive mechanisms need to be in place before you can go offensive and attack the investing markets. And if you want the like-minded community interested in investing, then join us at close to 20,000 members in the Honey Money SG Telegram group. Okay, make us 20,000. Okay. Let's go. Now, last year when I touched on this video, I separated it by levels, like level 1, level 2. Now, I feel that looking back, it should not be level because it seems like some levels are preferred over the other. To me, I want to add an important concept, right? I want to add like a calculation of total returns. And total investment returns includes your capital gain plus your dividend gain plus foreign currency fluctuation gain or loss, if any. So I want to apply this concept through this video because some of your point of view, right, for those of you who are investing, maybe you only look at growth, maybe you only look at dividends, but some of you forgot about FX. Some of you don't look at the total picture. So we should always incorporate these three factors in mind. Alright, capital growth, dividend yield, and as well as FX gain or loss. But I guess the fundamental reason is why should you even start investing, right? Because it takes a hurdle for people to start investing into an unknown realm, it's so complicated to some of you. And the reason that you must start investing is because fundamentally inflation. Money that is safe in your bank will erode over time. I'm sure your financial advisor is going to tell you this and I'm going to sound like them. But the truth is the Singapore Consumer Price Index or CPI just raised 2.4% year over year. Unlike in 2023, the CPI rose 4.8% year over year, So you see, if your savings or your interest is not even exceeding like 3%, you are just like getting a pay cut. Your money is just eroding value over time. And I'm sure your favorite food in your hawker center has increased price from $3 10 years ago to now at least $4 or even $5 now. So you tell me, if you don't invest, your money is going to sit there and rot, It's not going to grow itself. And with that, let's move on to level 1 of investing, which is discovering the basics. This will be your options like Singapore savings bonds, the treasury bills, as well as CPF SA or MA. Now, I'm sure many of you will know what are SSB and T-bills for now, so I will not explain further. But the fact is, they are government-backed securities, which means that they are one of the highest level risk-free assets, as good as it is, in terms of security, in terms of government backing. They will not run away, is capital guaranteed in a way that it will not even have any form of investment risk because there's no risk in losing capital. The capital is secured, right? Because it is a bond, it is a treasury bill, okay? It's just that the returns may not be as good as other instruments. For Singapore savings bond, you may apply it every month after they have issued it. And then I think it's now hovering around 3% per annum if you look at it from the long term. T-bill is quite similar at around 3% return rate, just that you don't get the rates published before you apply for it. You just have to wait for the auction. Then for CPF, I covered a lot about it in my channel, and one of the most fundamental magical number that you should have in your CPF is minimum $60,000 with $20,000 or less in your CPF ordinary account, because all these funds will earn 1% additional interest. So if you haven't hit that 60,000 number, I think it's good to at least top it up to $60,000 combined balance first, so that you can at least get the 1% additional interest, which is almost free money. But my general sense is that even if you invest in all these low risk instruments, you're not going to beat inflation in the years like 2023, where inflation is like 4.8%. So in investment theory, we should always relate to this trend: low risk, low rewards, high risk, high rewards. But even if you move up the level in terms of risk, higher returns are never guaranteed, other than all these low risk capital guaranteed assets. And it's not like real investing, right? Because there's no risk in losing capital in SFB, T-bill, or CPF. So it's not like real investing lah. You need to move up the ladder if you want more returns. So let's move up the ladder, which is level 2. Now we are into money market funds. And for those who do not know what money market funds or MMF are, it is a type of mutual fund that invests in short-term fixed income financial products that are highly liquid, such as government bonds, cash equivalents, and debt-based securities. So it is a step higher, because in order to invest in money market funds, you will need to have a brokerage account, because you will need to deposit funds in order to subscribe or buy money market funds. And this is like the preparation stage before you start investing into real equities or other things, right? Because you put your money into these funds, the idle cash in these funds can generate returns passively, sometimes even every day. So the real purpose of money market funds is not really to let it sit there long term, but it's more like to let your cash funds earn some passive returns while you prepare to invest into the market. Okay, it's always like a standby phase. And the fact is, when you open a Moomoo account, you can subscribe to these money markets funds for free. There are no fees charged for subscription or redemption, and you can either park your funds in SGD or USD in the Moomoo Cash Plus funds, and this will be the returns as of the date of recording. Of course, past performance is not a guarantee of future performance. This is a standard disclaimer. Then for most platforms, once you execute a trade, it will deduct the cash funds from the money market fund portfolio automatically. There is a feature that you have to unlock. For example, in Moomoo Cash Plus, the Smart Save feature will help you auto-redeem and repay account deficits in the same currency. So for example, you have Moomoo Cash Plus in SGD, then you buy Singapore stocks, then it will deduct from your Moomoo Cash Plus in SGD fund site. So like I said earlier, it's like a standby phase, right? You can use the Cash Plus funds to purchase stocks and other products directly, and will not affect your chance to enter the market in terms of the timing difference. But on the risk level, it is slightly higher than government securities, because capital is not guaranteed. Money market funds is ultimately an investment, but at least you can still use it to beat like 2024 inflation rate. And more importantly, it gives you the opportunity to trade or invest timely without having you to transfer funds from other places, and there is some lag time in terms of funding and deposit. But I do need to remind you of the foreign currency exchange fees, because some of you may see that USD has higher return, right? Then you all want to use SGD to convert. So always remember, for foreign currency, example USD, you are subjected and exposed to foreign currency risk, which could go totally both ways, where it could give you a FX gain or a FX loss. So you must consider that before you do a currency conversion. So for those of you who are ready to open a brokerage account, you can also check my link in the description to sign up for a Moomoo SG Universal account, because you can get attractive welcome rewards. Like, you deposit $100, you get $20 of trading cash coupon. And then if you fulfill the cumulative deposit criteria like 3,000, 10,000, 50,000, or even 100,000 tier, and you complete all the holding and trade requirements, you can get up to 800 Singapore dollars of rewards, which includes 450 Singapore dollars worth of Tesla shares and 350 Singapore dollars of trading cash coupons. Terms and conditions apply. Of course, do refer to the official T&Cs as always. So remember, if you want to sign up for a brokerage account, always sign up with a referral link, because you get more rewards. Don't just sign up without any rewards, because you will just be shortchanging yourself. So check out my link in the description to sign up for a Moomoo SG Universal account today. Now let's move on to level 3, which is index funds and ETFs. And this is my current strategy of investing, because it offers the most passive approach. For those who are not familiar with ETFs and index funds, basically you are buying a basket of stocks, index which holds one of the top few companies of a specific country or a specific index. For Singapore Stocks Index, we have the STI, Straits Times Index, ticker ES3, which tracks the best Singapore companies. I think it's about 30 companies, which comprises of banks, REITs, dividend stocks, and other large conglomerates in Singapore. Then for US market, you can track indices like the S&P 500, ticker VOO, and then there is also the Nasdaq Index, which is more tech focused with ticker QQQ or QQQM. But if you want to go even deeper, you can look at London Stock Exchange, where Ireland domiciled funds for the S&P 500. You have tickers like CSPX or SPYL or VUAA. All these are more tax advantage in terms of how you can invest them. But if you want a slightly more world index approach, you could look at VWRA, or you just want developed markets index, you could look at ticker IWDA. All these you have to do your own research, like which index you prefer for your own risk appetite. I cannot give you financial advice, but ultimately what am I investing in is just to track market returns. I acknowledge that I will never beat the market, and I'm sure many of you would not beat the market unless you have exceptional skills for the long term. Okay, beating market for the long term is very difficult. You may beat it in 1 year or 2, and I want to put myself in a position that I'm most likely to hold these positions in the event of the market crash, because I have been there. I have been stock picking, and I've experienced that in a market crash situation, I was not able to hold on to those individual stock counters because I do not have conviction or enough research about them. But for index funds, I'm very comfortable to hold them because I know that in the long run, the market indices do trend up. But of course, past performance is not a guarantee of future performance. So just do your own research on what is suitable for you. Now, one simple way to start investing in this is to dollar cost average into positions. And to dollar cost average, you have to use a regular savings plan, which is common in a lot of brokerages. So for today's video, you can check out Moomoo RSP. So on your Moomoo app, click on markets, then US, then RSP. And on RSP calculator, you can even calculate how much you could have earned if you invested $1,000 monthly for the last 3 years. And that is close to a 30% return. And in the Moomoo app, you can create your own RSP plan depending on which counter you want to do your RSP in to dollar cost average into the positions. So that's how an RSP with Moomoo can help you take away emotions, because you want to automatically invest. You don't want to be too involved in the market. You want to go on to do other things. You want to build your business, build your career, build your network and your family. You don't want to sacrifice time to research about stock market news and analysis, so boring and complicated, right? Then just do passive investing lah. Level 3 is good enough. Now coming to level 4, which is the ultimate stock picking. Because stock picking can be both picking growth stocks or dividend stocks or a mix of both. So dividends, for those of you who do not know, is like company distributing the profits or the retained earnings because they have enjoyed a great year of financial profits or growth. Then they just want to give back to their shareholders. So dividends are distributed in the form of cash or stocks, with cash being the default option. And for dividend stocks, I would say look at Singapore market. It's more favorable than US, because for US there's the dividend withholding tax, which makes it less favorable. So if you want to look at dividend stocks, for Singapore, the most famous dividend stocks must have been the top 3 banks, DBS, UOB, OCBC. There are also other dividend players in the SGX stock market as well as something known as REITs, Real Estate Investment Trust. But I will not go too deep into those. To me, dividend stock investing is only when you need the cash flow, the consistent monthly cash flow in your retirement years. If you have like a job giving you a monthly salary and you're not in need of those cash flows, then I feel that it should not be a priority, because you should look at growing your portfolio, accumulating over the long term, and not just keep taking cash flow from the market, which is why I mentioned at the start of the video, right? Capital gain, dividend plus FX gain or loss. So let's talk about capital gain now. Capital gain is ultimately just buying low and selling high when you need it. So if you don't need the money, you don't have to sell. You just let it slowly accumulate over the long term and let it grow. Now, stock picking is quite different from passive investing into index funds or ETFs, because it requires a much higher level of advanced skills and research that makes you need to read financial reports, analyze charts and patterns, and market news that you have to understand at the very first minute. So it's definitely not suitable for beginners, but if you have interest in this, then you can definitely look at other creators who are in this space. But recently there has been a big discussion on dividends, right? Like, is dividends still relevant? To me, dividends is ultimately part of investment returns. If the dividend is good, but there is a very big capital loss, then ultimately you are still going at a negative return year. So I heard there's this very popular statement like, I don't care if stock price rise or drop. I just collect my dividend every quarter. To me, this is a loss aversion mindset, like you're trying to comfort yourself, because there are many cases with dividend per unit trending down with the stock price decline. And you realize that all these capital losses are even more than the dividend yield itself. So don't just measure a stock performance by its dividend. You have to look at the total returns, which is what I mentioned. So to give an example, one of my more lucky stock pick positions was in Apple. AAPL. I do have 180 shares of Apple in my Moomoo app. It's at an average price of $148, and as of the day of recording, it is around $230 to $240 per share. So you see, the share price has appreciated over the years, even though the dividend yield is just like 0.4%. So sometimes you must look at the total return, right? And if you look at the past 1 year return of Apple stock, it is 30%, So that will really outweigh the dividend yield. So don't just look at dividend, you have to look at the overall stock performance as well. And please don't take this as financial advice and just all into Apple, because I've done my own research and I was lucky at the point of entering Apple, it was not as overpriced as now it is. So you may not get the same result So repeat after me. Past performance is not a guarantee of future results, and this is not financial advice. Repeat in your head. So having gone through all these levels, I would say that there is no best level, alright? Just pick the level that is most suitable for your own risk appetite. Some of you may be just comfortable with level 1, which is fine. Some of you may be just comfortable with level 2, and then you are dipping your toes into level 3 or even level 4. To me, there are many roads that leads to Rome, and there is no point trying to despise others because they are, different level than you. So just mind your own business and pick the best for your own risk appetite, because no one cares about your own personal finance better than you do. And now if you're interested in my own portfolio allocation, then I may refer you to my $1 billion net worth video right here.